Hey guys, I'm Hunter with Nelson Insurance. I'm going to go over total cost of risk versus just insurance premium. I gave a speech on this at the South Dakota Trucking Association, so I'll kind of post that video too. But I'll just kind of narrow down into one section here on looking at your guys' insurance policy. So whether you guys are one truck, 100 truck, 1,000 trucks, I see that a lot of people are going in there looking at, hey, what's my insurance premium? How can I get this down? Insurance is just a, expense, blah, 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 blah. All I have for control over this thing is quoting, okay? So if you're a one truck guy, I mean, yes, a little bit of this is going to apply to you. It is going to be less applying to you on certain things. But I'll kind of go over this for everybody here, right? So I'll show you guys how you can either have less payouts of your own pocket if you guys are having a lot coming out of your own pocket, or you can take on more of that exposure, okay? So when you guys are buying insurance, you are buying the transfer of risk, right? You are transferring the risk to the insurance company, and you can either take on more of that risk, or you can, give more of it away, right? So it depends on how much you guys are actually paying out. So like every dollar, the statistic is every dollar that you guys pay an insurance premium, you guys are going to incur $2 to $5 in indirect cost. The time associated with all that, the driver being at home, the truck being in the shop, the reputation damage, the time associated with it, the lost revenue, all that, the list goes on and on. The extra expense you guys got to pay for risk management if it was bad or whatever the case is, right? So with that, you guys kind of get the two routes like I was saying. You guys can either look at your insurance policy, review it, see, hey, how can I pay out less next time if you guys are having lots of claims? Or you can kind of go in and go, well, I'm already paying $2 to $5 on the indirect costs. How can I instead of paying so much on insurance because it's only going to, cover a dollar of it, how can I actually even lower that, right? So I'll get into if you guys are clean risk, you're betting on yourself, you want to pay for as little on insurance as possible, right? The options you guys have there are your deductibles, your SARs, and captives, okay? So let's say you guys are paying $700,000 a year for insurance, okay? And you're like, at this point, I feel like I'm donating money to the insurance company. You're paying $700,000, they're paying out $70,000 in claims a year, but you got a bunch of trucks, and so there's not really much way you can get to below 700 grand. Yes, you can go shop. Great, I found some for 600,000, whatever. Okay, you just saved yourself 100 grand. Shopping, I'm not saying is a bad idea. You should be shopping every couple of years, just make sure things are right. If you take a big grade increase, whatever the case is, right? You need to be shopping every couple of years. We shop all of our clients every single year just to make sure nobody's cheaper. Or if they are, hey, we're going to get your rates down. I mean, we had somebody where $19,000 for their one truck was the best option they were getting by a long shot. Okay, everybody was really expensive, whatever. It's kind of a weird situation. And we got them 19 grand, renewal went up to 22,000, shopped around. Sure enough, it was $8,000 for that exact same thing because they had a year in business, clean operation that year, whatever. Now it's 8 grand. Even the second best option was 14 grand. So saving a lot of money, okay? So I'm not saying shopping is bad, but I'm saying it shouldn't be the only thing you're relying on, okay? So if you guys are just donating money to the insurance company, you guys have deductibles. How much can you keep? How much can you guys take on? You're like, I don't want to turn any claim under $50,000. We really don't have a whole lot of claims. I can pay $50,000 in a claim, and I don't want to be taking on all the exposure. Okay, so bump your deductible to 15 grand, see what it looks like. But you guys got to do the math on it. The total cost of risk versus just the premium, right? So if you guys have a $50,000 claim and you bump it from $1,000, let's say, okay, and you go to $50,000, well, let's use 50 grand for easy math here. If you turn in a $50,000 claim once a year and it saves you 50 grand, you guys are breaking even, right? If it's more than once a year, you guys do it 5 times every 4 years, you're losing money. You guys do it 4 times every 5 years, now you're making money, right? Just depends on that total cost of risk there. In SAR, well, the deductible is typically going to be put on just the physical damage and cargo. You can put on the auto liability, but more commonly it's going to be an SIR, a self-insured retention. A deductible will be taken out of the payout, or you're going to be paying it afterwards. an SIR, you're going to pay that, then the insurance company's going to step in, okay? So that you can go and usually put in your auto liability, where its deductibles are less common on the auto liability. You can do both. And then you guys have a captive, okay? I made another video on a captive. A captive is like your next step to self-insurance, okay? You guys can totally be self-insured. I'm not going to get in that whole spiel here. You guys got to have a ton of trucks. You better be having a lot of money set aside, okay? A captive is going to be like you own the insurance company. So I'm going to go get a captive. I am, without getting too much into it here, there are single-parent captives and there are group captives. A group captive is you're going to be in a group in a captive with other trucking companies. A single-parent captive is going to be single person, single company, whatever, right? It is going to be just you and that captive. Now, for a single parent, you're going to be paying $1 million, usually at least $2 million a year. A group captive, you can get in at $250,000 a year. You can get in at $600,000 a year. Depends on the captive, what their minimum is, but usually the lowest minimum is be $250,000. A captive doesn't automatically mean you're going to be cheaper. You can't get into a captive if you're paying $250,000 a year and every year you turn in $300,000 in claims. It ain't going to work, okay? You got to be turning in very little claims, typically under 20% loss ratio. So $100,000 in premium, $20,000 in claims, 20% loss ratio, okay? And then you got to have 5 years in business, blah, blah, blah. And how that works is, okay, I'm going to be an insurance company. How do insurance companies make money? They invest that money. You guys paying your $1 million a year, it gets invested, you earn dividends on it or interest. You guys start building up a cash flow there. The reserve of the insurance company, how much money they got set aside for claims. You guys turn in less claims than what you're paying, it's going to start building up there. You can take some of that money back now, okay? You are going to pay a captive fee, and so some of that money is going to go to the captive, but most of it's being going to your what's called a fund, okay? If you're in a group captive. You guys are going to be having basically a huge deductible. Let's call it $300,000, okay? You'll be paying out all claims under $300,000, and then the insurance company will step in on massive stuff. The reinsurance, that's what the captive does. You guys are basically going to be self-insured here, like an insurance company, be reinsured for massive stuff, so over $300,000 in a claim. Or if that thing runs dry, your reserves run dry, just like an insurance company. They have reinsurance. Oh, hey, I'm such and such insurance company. I got $1 billion in premium. I just used it all. I just used all my reserves. Boom, here comes reinsurance, right? But you got to pay for it. So that's where the captive fee comes in, okay? So if you guys are really betting on yourselves, you guys got all sorts of options there. How to lower your total cost of premium, your total cost of risk, all that sort of stuff, okay? Let's just say you're looking at it. I'm buying insurance through the marketplace. That's like going to a Great West, Progressive, Century, Midwest Family Mutual, 10-4. List goes on, right? You're not paying insane amounts of premium. You don't want to take on the risk. You don't have a couple $100,000 laying around, right? What do you do now? Lower your total cost of risk, which will lower your premium and lower your indirect cost. That's going to be safety teams, tech, maintenance. For maintenance, get a mechanic, get some software, have that thing break down as least amount as possible, and have less fires, have less claims, have less everything, right? We just had a $117,000 trailer fire, and I don't know what happened there, but probably started from a mechanical issue, right? Or something along those lines. Tech, dual-facing dash cams, keep an eye on your drivers. Are they causing you problems? Distraction detection on them, if they're getting fatigued, any of that type of stuff, right? ELDs, collision avoidance software, turnover avoidance software, or hardware, whatever, tech, okay? Automatic braking, I know some of you guys don't like this, some of you do, whatever. There's all sorts of tech to lower your claims. Get a safety team. Hey, you have, I don't know, 3 alerts on your CSA scores. For one, it's going to hurt your revenue, right? But you spend a lot of time getting inspected. You spend a lot of time getting audited. Get that stuff lowered. Have them look at your hiring, look at your training, your compliance. Have it be a prevention versus a cure, right? This is how you save money on insurance, and you can go ahead and shop too, right? But you don't want to go shop every year and go, Well, I've been paying 100 grand a year and I've been turning $200,000 a year in claims. Who's going to be the cheapest option? Now you're sticking a band-aid on a missing wound. You're going to keep bleeding out and go out of business, right? You have to lower your risk to go into the insurance company and find and be a better prospect for them, right? They're taking a bet on you. They're obviously not a charity. They're trying to make money off of you. So show them that they're going to make money off of you, right? And then they want to be competitive and own as much of the marketplace as possible. So they're going to lower your premiums if you're looking good. So going to do that. Also, make sure you guys have insurance for the stuff that matters. You are transferring risk. So anything you do not have insurance for, you are keeping that risk, right? So if a cyber attack happens, you are 7 times more likely to have a cyber attack happen than have a fire. And 61% of businesses that have a cyber attack go out of business. If you can't pay for 2 months of sitting still, or a fake invoice happening, or somebody getting a hold of your fuel card, then you should definitely have cyber insurance. It's really not that expensive. Maybe $1,000, $2,000 a year, depends on the policy you buy. You guys go pay 10 grand a truck, So cyber insurance, pollution liability. There is the MCS 90. If you guys don't know what that is, that's your federal filings. That's what activates your MC number, your authority. On that MCS 90, you guys sign something saying the insurance company does too, saying they are going to pay for all public liability, which I'll just explain what that is. Public liability is bodily injury, property damage, environmental damage, no matter what. Even if it's not supposed to be covered, the insurance company's going to pay it out. Then they're going to come sue you for everything. So there's no settling in court. They're going to come sue you for everything. It's already been paid out, right? You're not going to go to the state of Minnesota and go, hey, yeah, I polluted the river. I don't have money for it. Let's settle, see what we can do here, right? Let's work out a payment plan, whatever. No. The insurance company's going to pay it out, and they're going to be like, well, you owe us the money. Give us it now, whatever, right? So have pollution, EPLI, employment practice liability, all this sort of stuff. Know these coverages, because if you can afford to pay for them out of pocket, you're going to go out of business. And that's ultimately what you keep insurance for, is to keep you in business, right? So there's total cost of risk versus premium. Yes, I'm not saying shopping is bad, but shopping being the answer to solve your problem, it's not what you want to do, right? You guys are going to be looking at this as a 3-year plan. Shopping might get you a win year 1. You want to go shop every single year. You may want to find an insurance company that's going to take a bet on you, show them what you're going to do, and then they'll keep decreasing your premiums if you find a good underwriter who's got common sense underwriting, right? Not like a Progressive who you just go rate it online and whatever happens next year at renewal. There's no say to it. Go tell the insurance company what you plan on doing, then go do it. They'll save you some money their first year, and you keep doing it. And after you guys you're like, heck yeah, I'm as low as risk possible. Go to a captive, get SARs, raise your deductible, go find insurance companies like, holy crap, these are what these guys have done. I'm going to make stupid money off them. Shoot, yeah, they are. And that's what you guys want, because then, you're really low risk. And once you guys qualify for a captive or high SARs or whatever, your insurance is going to go down. You can stop paying for insurance on some of the stuff. Like you can go be a captive and just start buying back some of that exposure, right? So if you guys have any questions on this, please let me know. I'm Hunter with Nelson Insurance Agency, just trying to educate truckers on every chance I get, okay? So if you guys like this, please like and subscribe. Please reach out to me with any questions. A lot of guys do, and I love talking to truckers, okay? Appreciate you guys watching. Thanks again.